Let's start off with risk and the potential risk that might actually be out there on the horizon. What do you have your eye on right now?
We've been talking to a lot of clients about emerging markets risk right now. Particularly, they've been asking us a lot about how we see the Evergrande crisis unfold and how we're mitigating that risk in the portfolio. So that's certainly something that we're still focused on, even if the market wants to focus on other things from one day to the next.
Talk to me, Olivia, when you're thinking about some of that EM risk. Do you find China investable? I know clients are asking you about it, but at what point is it EM ex China as your next investment strategy?
That's it's pretty typical. People ask us often talking about wanting to break out their China exposure. We think that China as a whole, it's not the most highly rated country out of the emerging market segment. We prefer in Asia, Korea, and Taiwan for better opportunities. But to us, it's a little bit more about what are the sector exposures you need to be mindful of at the moment. And with something like Evergrande happening, there's obviously the direct stock-specific exposures you need to be concerned about, particularly in concentrated portfolios. But more so for us, it's about what kind of diversified exposures, what kind of thematic exposures could come out of the knock-on effects from Evergrande. So there's three sectors that we are looking at carefully in our EM books to be mindful of that risk. Obviously, the real estate sector is one, the banks is another, and the materials, the third important one for those direct knock-on effects.
Olivia, it reminds me of an issue here that maybe a lot of investors have taken their eye off of, which is leverage in the system more largely. Are you looking at global investors and saying maybe they should be borrowing a little less when it comes to both corporations and funds?
Well, when interest rates are this low and the monetary policy is so accommodative, it is natural for investors and all kinds of market participants to take more risk. So that's a natural fallout of that kind of environment. So, and that poses new risks on a go-forward basis. But yes, we think that we need to be really careful of risk-taking in this kind of environment.
I am curious about the yield move, though. I mean, obviously, rates are still, at least by historical standards, pretty much at rock bottom levels here. But there's always a concern here about how fast rates rise and whether that catches people off guard. We're at 1.5 on a 10-year. We're 16 basis points higher than where we were just, 7 or 8 days ago here. Is there any sort of concern on your part here that we could sort of be faced with a situation where yields rise much faster than what the rest of the market has priced in?
Yeah, that is a real risk. I think that as well as inflation. So interest rate rises in any meaningful way we haven't seen in a long time, nor have we seen inflation. So the way you need to protect your portfolio from interest rate exposure needs to be quite holistic. You need to think about segments of the market that have long duration versus shorter duration and balancing out those exposures, not trying to take a bet one way or the other, because it's really unknown when the volatility around interest rates has been so high.
But Olivia, on that note, I am curious what the quant models are signaling to you about the why behind rates rise. And if they're going up for strong growth and strong inflation, does that then further make the case for equities?
Well, actually, when it comes to the quant models, we're thinking more about the fundamental characteristics of the companies themselves, and we claim less to be experts in the direction of the interest rates and more about how companies react to the interest rate change. And so it's really important for us to look at quality attributes, for example, capital ratios in the case of the banks. So, the China banks, for example, have some of the lower capital ratios compared with some other countries and their banks. So, the quality attributes are really important. Also, what kind of sentiment is the market is telling us about how they feel about these companies. It can often tell you a lot about a company before you even need to know it. So real estate sentiment signals in the real estate segment have actually been coming down in China for many, many months. So the market has been telling us that there's something going on here, even before the Evergrande situation really blew up.